Greeting, folks. This is Dan Bird on May 14th, Sunday. Happy Mother's Day, everyone. I'm recording on my own today. Zuber is taking the day off, so it'll just be me. And this is just going to be one session today. So I think it'll be pretty quick. I'll take you through what the market looks like and then look at some of the sectors and see what they're doing. So hopefully it will be useful for you. For those, let me share my screen for those that have not started receiving my newsletter. Here it is. If you want to get it, just send me a note to breakpointtrading@gmail.com and I'll add you to the list. I just sent it out this morning. The last group went out this morning. And there's a long article in there. I wouldn't be surprised if folks don't read the whole thing. But it's very fascinating. It's very interesting. This is from Real Investment Advice. It's actually also a free newsletter, and I put the link in there if you wanted to subscribe to it. But they have some very interesting historical information about the market. And this is the bull market that we've been in basically since 2013 officially. And we exceeded it, of course, in 21, and now we are correcting. So a correction to me means we actually are correcting, bringing it back to the mean or back to normal, essentially. And you can see right now we're trading in this range right here, and we're getting towards the top of it, which is at about 420 on the SPY, which is 4,200 on the S&P. And that is a critical area. So if we can break through it, then I think very quickly we're going to get to 4,300, which is the next level. And then after that, then we may be headed back to the highs. But as you can see, we could actually end up staying in this upward sloping channel for quite a long time. So we might make it to 4,200 and then reverse and come back down. I don't know if we'll get to the bottom of the channel, but we may just bounce in this area for quite a while as it very slowly churns higher. So we'll see if that occurs. The other chart that I put in, I talked about this previously as well, is the comparison with this year to 2011, which is the last time we had a major debt crisis. Now, the debt ceiling gets raised all the time, and it really is about politics for the most part. Now, there are some other issues that involved regarding the reserve currency, but I talked about that on Wednesday, but I'm not going to get into that today. So it is important that we curb spending. If we continue to spend like we are, it's going to have significant impact on everybody, the whole economy. And, you know, we might have a few more years left that we can continue to do that, but it's not going to last. So we do absolutely need to curb spending. But that being said, one of the cartoons I put in this week is this one right here in 1917, when they created the debt ceiling. You can see Democrats and Republicans getting together saying, let's create something artificial. We don't need, so we can, something artificial we don't need, so we can fight about it for 100 years. And here we are 100 years later. That's the debt ceiling. So do we necessarily need a debt ceiling? We don't. And as long as we are the reserve currency, then we can continue to spend and continue to run up our debt as long as other countries continue to buy our debt. But at some point, that's going to end. And when it ends, the higher that debt is, the worse and more painful it will become. At any rate, this is the year 2011, which is the last time there was a Republican House with a Democrat president. And that's typically when we get into issues with the debt ceiling. When you have two different parties that want to make a point, the point being that we need to stop spending money. And of course, the other side, the Democrats, know that we have to raise the debt ceiling, so they'll just hold fast and continue to spend money. And it will most likely, or it better, get raised. So I'm pretty sure that it will get raised, as it did in 2011. But you can see where we are. The blue line here is where we are this year, 2023. You can see how closely it's tracking with 2011. We're right here in the middle of May right now. Beginning of June is the first deadline for the debt ceiling. If we miss it, it does not necessarily mean that we default right away, but it will have serious impact on the market and really our credit rating. So you can see here in 2011, Republicans declare an impasse. IMF says U.S. must lift debt, limit to avoid severe shock. July had a bad jobs report. I don't think that's going to happen this year. S&P threatens to cut U.S. credit rating, and then they do cut the credit rating in August. And you can see the market went all the way down. So we're tracking right along with 2011 right now. All of the politics are very similar to what happened in 2011. I suspect that it will have the same outcome, that they'll take it right up to the last minute, and then they will eventually raise the debt ceiling. I'm not sure which side will win. I doubt that either side will win, really, because they have to raise it. But if we also get a credit rating cut, then this is what might happen in August. So something to be aware of, be careful of. I want to show you where the market is right now. You can see that we've just basically been trading in a sideways channel for the last 6 weeks. All of this, by the way, is in my newsletter, so I put a lot more detail in there. So we've been trading sideways for the last 6 weeks in this range between basically 41.75 and 40.50 on the bottom side. Now, even though we've gone sideways, the good news is there are a lot of open candles in here. An open candle means that the market closed higher than it opened. So it was an up day, basically. If it's a closed candle, then that means the market closed lower than it opened. And that gets colored in red normally, unless that same thing happened, but it still remained above the previous day's close. And then it still is a closed candle, but it's black instead of red. So the important thing is there are a lot of open candles. That's good. There are also a lot of tails on some of these candles. So you can see what that means is candle basically tells you what happened during the day. So the market opened here, it traded all the way down. So it had a big sell-off during the day. This was Friday's candle. And then at the end of the day, it came all the way back up. In this case, it went below the 21-day and came all the way back above it and closed higher. So that leaves a long tail at the end of each of these. And that long tail, you can see it over here. You can see it on these up here as well. That long tail means that there is selling in the morning and there's buying in the afternoon. That means big institutions are waiting for retail traders to think that the market is crashing again, and they sell out, and the big institutions buy those shares. They're happy to take them off your hands as you're selling. So that leaves a long tail on the candle, which means there's afternoon buying by big institutions. That's also how the accumulation distribution line works. So the accumulation distribution line basically takes the price for the day and determines whether it ended the day in the upper half of its range. If it did, it ticks this line upwards. If it didn't, if it ended in the lower half of its range, then this line goes down. You can see here that ever since back here in the middle of March, when this recent rally began, the accumulation distribution line in general has trended higher. That means in general, each day has ended above the midpoint of its range. Again, institutions buying in the afternoon. So this continues to go higher. In fact, it's reaching another high, 52-week high up here. So that's good news. But everything is pretty flat. I mean, the volume is below average. The RSI is flat. The momentum indicator, PPO, is pretty much flat. So everything is just going sideways right now. What does this look like on a long-term chart? So these 250, the quadrant lines, this is a quadrant is 25% of the range from the COVID low all the way up to the 2021 high. So from the low of 2020 to the high of 2021, that range, those two right there represent the 50% point and the 75% point of that range. And you can see we went right down to the 50% point in October, put in that low, which probably is going to be the low for this recent decline. And now we are slowly moving higher. But now we've got into this range right here, the shaded area that has a lot of congestion. There's a lot of resistance in through here. There's a Fibonacci level on the orange line. There's the quadrant line, which we keep hitting against and getting rejected. And then there's the 4,200 or 4,300 level right here that we need to negotiate through. So all of this is causing a lot of congestion, a lot of traffic. It's getting backed up and getting rejected here and trading back down. Now, right now, the 50-day has been acting as support, and we went right down to it on Friday and bounced back up. If that gives out, then probably we'll go down here to where the 200 is, which is about 39.70. But 40.50 really is the one to watch because that's the recent channel that we've been in, 40.50. If we break 40.50, then we could very easily get back down to this 39.50 area and even down to the next 38 and 38.2 Fibonacci level of 38.15 that we've been watching for quite a while. But we have to see if it's going to break through that. And right now it's holding up. It's just basically hanging out in that area and trading sideways. So we'll see what happens. This is the CPI report came in a little bit better than expected on Wednesday. Not much better, but a little bit better. So the reaction from the market was muted. I thought the market might use that as a catalyst and start moving higher, but it really didn't. So I think the debt crisis is really what the market's waiting for to see how that gets resolved. But something that's interesting here, number one, that we hit this peak on commodities in the middle of April, and since then everything has been selling off considerably. So that's bringing inflation down. The next inflation report should be a really good one. In fact, it might show inflation just dropping off a cliff. The other thing to point out here is that whenever the Fed starts raising rates, usually the market sells off initially, and then it gets used to rates being raised, in fact, anticipates it because the market looks 6 to 9 months ahead, and then the market starts going up. So you can see what happened here. This is the second rate hike, 50 basis point right here. The market continued to go down. We had 3 75 basis point hikes till we got to October. Then we had another 75 basis point hike, but the market had started rising since then. So it had already started anticipating either an end to rate hikes or even rate cuts at some point in the future. And ever since then, for the rest of these rate hikes right here, which basically is a full 2% rate hikes, the market has trended higher, even through all these rate hikes. So that's interesting to take a look at. The VIX, as we always like to look at, the VIX is still hanging out at the lows. The VIX looks 30 days ahead and determines what the volatility index for options are going to be 30 days in advance. So this is really telling us that in the future, there's not much fear in the market. Right now, it's sitting at right at 17. So if it gets below 16, there's never been a bear market where the VIX has been below 16. Cyclical bear market. So it's still trending lower. It's still in good territory. You can see the S&P is going sideways. Put call ratio is kind of hanging out in the same place. Everything is moving sideways, including the 10-year Treasury yield. So everything is just, stuck in neutral, basically, waiting for a catalyst, waiting for something to happen. The US dollar, though, is interesting. US dollar has spiked higher in the last few days. So this caused gold to go down slightly, dollar to go up slightly. As you can see on the chart for the dollar, we had a big spike here from February to March, and then it sold off and actually went to a new low. So we'll see what happens this time. So it might spike higher again, and then we'll see if it can take out this high over here. I suspect it's probably going to reverse and go lower as well. and gold will continue to go higher. That's what I think will happen, but you never know. Never know what's going to happen. But that's what the dollar looks like. Okay, let's look at the sectors real quick. So the sectors, this is interesting. This is the intraday. The sectors on Friday were defensive sectors: utilities, consumer staples, real estate. Those are, and materials and energy. Those are all defensive sectors right at the top. Now the S&P is right here near the bottom. So anything above that actually outperformed the S&P. The two that did not outperform are financials and consumer discretionary. Consumer discretionary is one of the three aggressive sectors. It's one of the three that we want to see leading. The other two are technology, which is the biggest sector of all of them, and communication services, which is where the internet stocks are. Things like Meta and Google, a lot of the internet stocks are in that. So those three, communication, technology, and consumer discretionary, are what you want to lead. They weren't leading on Friday, but let's take a look at what they did since the beginning of the year, year to date. Now you can see all three of those sectors are the only three that have outperformed the S&P. So since the beginning of the year, the market is clearly in a risk-on mode, in a bullish trend, aggressive trend. Money is rotating. This is the opposite of what happened in 2022. Money rotated out of these sectors and into the defensive sectors. As of the beginning of this year, the opposite is occurring. Money is rotating out of defensive sectors and into growth and aggressive sectors. Now, if we go back, let's go back 3 months, and you can still see communication and technology still outperforming the S&P, but consumer staples, which is one of the defensive sectors, and utilities are also outperforming. So there's a split now between aggressive and defensive. And consumer discretionary has dropped down here. Let's look at 1 month. 1 month out, we've got now discretionary has moved back up along with communication and technology. Staples is still up there though. That's interesting. We're going to actually look at staples in a second because it's very interesting that that particular group is staying strong. Then we'll come a little bit closer in 1 week. Communication, discretionary, utilities, staples, and technology. So now there's a mixture of aggressive and defensive sectors that are outperforming the S&P. So remember, anything above this S&P line are outperforming. And then if we go down to 1 day, which is Friday, now again, a lot of them outperform the S&P, but the ones at the top now are all defensive. So we need to watch that and see what happens next week. But the trend in general has gone from all aggressive to a mixture of aggressive and defensive to now on Friday, all defensive. So what I'd like to do is take a look at a few sectors from a relative standpoint. So this is relative to the S&P. So the way to read this chart is if this pink line is trending higher, then this particular sector is outperforming the S&P. That's the way to read it. So this is the consumer staples sector. And ever since the beginning of February, you can see that it has clearly been outperforming the S&P and moving higher. This gray area is a weekly trend. So it basically converts this daily chart into a weekly. So we can see how it's been doing on the longer term. And again, it too has been basically outperforming the S&P, even though barely. Now let's look at the aggressive sectors. Let's look at technology. Technology clearly has been outperforming ever since January. And that's really what happened in January. Technology started to take off. Had a little bit of a pullback here in April and then started moving back up again. Weekly trend again is clearly above zero. And this is the actual sector, what the sector chart looks like. Now, if we look at the individual sector chart, we can look at Actually, this is a weekly chart. We can look at the daily chart for consumer staples. And this is what the daily chart looks like for staples. Actually looks fairly bullish. So staples, ever since October, even though it pulled back from January when technology started to take off, staples pulled back in March, which is kind of what you would expect. You would expect the aggressive sectors to move higher and the defensive sectors to move lower. But ever since the beginning of March, this defensive sector has been moving higher. Now, what makes up the top 10 for this? Top 10 in consumer staples, it's fairly well distributed. So we've got Procter & Gamble, Pepsi, Coca-Cola, and Costco, the 4 top holdings in this particular sector. So all 4 of those have actually been doing fairly well. And then Walmart is the next one. So let's take a look now at technology. Let's see what technology looks like. So technology has a cup and handle that I pointed out previously. And it's sitting right at the breakout point for this cup and handle. And if this does break out, then there's a potential for, you can see the cup right there. And then this neckline goes across here. It's actually just barely at it right now. But if that does break out, there's a potential for this to equal this bit right here. So from 150 to about 112. So that's what, roughly 35 points. So this could get up to 185 is the target for this. So that's what the actual daily chart for technology looks like. What does the chart for, let's see, here's the daily chart here. Okay, so we just looked at that one. So the top 10 in technology, this will be interesting. Top 10 is, as you would expect, Apple and Microsoft. Those 2 make up 46% of the whole sector. And those have been moving higher. So you would expect technology to move higher as well. NVIDIA is the next one on the list, and Broadcom is the next one. So these 2 in particular, we need to really watch. We want to see Apple and Microsoft continue to move higher because they make up the bulk, 46% of that whole sector. Now let's look at the communication sector. The top 10 in that sector is Google and Meta. That's 46% of that whole sector. And then Netflix is the next one on the list. So these 3 make up 50% of the whole sector, and primarily Google and Meta. Google has been doing well, and Meta has been doing well as also. Pull back a little bit, but it's still hanging in there. So these 2 are the ones to watch in the consumer services sector. And then finally, the one that's been lagging is discretionary. Consumer discretionary, the top holdings there is Amazon at almost 23% and Tesla at almost 17%. So that's 40% of the whole sector made up of Amazon and Tesla. So we need to watch those as well, because this is really the last aggressive sector that has been lagging. We would like to see this start to move higher. There's what consumer discretionary looks like, and you can see that it's sold off back in August, tried to make a recovery in January along with all of the other aggressive sectors, and then basically has just been going sideways. So Amazon and Tesla make up that sector primarily. So that's what we need to watch there. So that's it for the sectors. We can look at the relative performance also of those sectors. And by the way, I updated all of these in my newsletter. These all have links in the newsletter at the end of the newsletter. So here's the XLY to the S&P right here. And you can see again, it had a little recovery back here from January to February, and now pulled back and just kind of moving sideways. It's trying to make another run, but it's not looking too good. By the way, if I look at my newsletter, let me bring this up. I should have had this ready, but I didn't. This is the newsletter, which I also put in PDF format. So for those that don't get the formatting in regular email, they can always look at it in PDF, and then you can see it much more clearly. So this is the full newsletter right here. I put in economic calendar for last week, where this shows you the CPI numbers, and the next week is a fairly quiet week. Although the end of next week is options expiration, so we have to be careful about that. That always makes things a little weird during the week with options expiration. At the very bottom of the newsletter, this is the commitment of traders report, which is very interesting. And basically what it says is the commitment of traders right now. This is basically identifies where traders are, whether they're short or long. And they typically are on the opposite side of where the market is going to go. So if they're all short at the same time, especially right now, there's a great deal of them short. In fact, it's equal to 2011 and 2007. Then they usually are on the wrong side of the market, which means the market will go back the other way. In fact, the title of this is Extreme Positioning Suggests the Bears May Be Wrong. So this is a very interesting, that's the chart I showed you before. It's a very interesting report. A lot of the things that I have been saying in the past are echoed in this report, like this 200-week moving average that identifies that we're still in a secular bull market. We haven't gone below it. But all the way at the very bottom is a list of charts down here. So the S&P, NASDAQ, 3-year charts. And these are the relative charts that I was just showing you. So you can click on any one of these. So if I click on XLC, this shows us the communication sector where Google and Meta reside. And you can see that on a relative basis, it is clearly outperforming the S&P ever since January, ever since these moving averages all crossed right here. That would have been the signal to start looking at stocks, looking at Meta and Google. So if you are interested in looking at any of those, you can always do it right from the newsletter. You can get to any of these. And by the way, you can then, if I want to look at energy, for instance, which has been terrible, you can see energy right here, clearly underperforming. Ever since February, had a bounce here in March, and ever since March, it's clearly underperforming the S&P. But once you bring this chart up, all you need to do is go up here and click on this little star and save it to your favorites list. So you can just take that link, save it to your favorites, put it in a folder, and all of my charts will always be there for you. Most of these charts don't change very much. When they do, I'll let you know. But you can always look at them and you can see things as they progress through each of those. All right, that's it for today. Let me show you the newsletter. If you're interested, send me an email to breakpointtrading@gmail.com, and I'll add you to the list. So thanks for listening. I hope everyone has a great Mother's Day. Enjoy your week, and happy trading. Take care.